that central banks will be buying gold and buying gold at record levels. And you also correctly pointed out that we will see the demise of the petrodollar.
Is the 2024 gold rush a sign of trouble for the US economy? As more investors turn to gold amidst rising uncertainty, this surge raises important questions. Let's explore what this trend means for our financial landscape and whether it signals deeper economic concerns. But what exactly is this 2024 gold rush and why is it happening? At its core, the phenomenon refers to a significant increase in gold buying. Investors are piling into gold as a response to growing economic uncertainties, including fears of inflation, a potential recession, and the weakening of the US dollar. In simpler terms, when people aren't sure what the future holds for their money, they look for something solid, and gold, a timeless and reliable asset, seems to fit the bill. So why has gold become the go-to asset in 2024? One of the biggest reasons is inflation, which reduces the purchasing power of currencies, has been a persistent problem for a few years now, particularly in the United States. When inflation rises, the value of each dollar goes down, meaning that everyday items cost more. In times like these, gold becomes attractive because it tends to hold its value better than cash. It doesn't erode in value like paper currency can, which makes it appealing for people who want to protect their savings. What's really driving this new surge in gold demand, though? It isn't just inflation. There's a growing sense of uncertainty about the overall stability of the US economy. The stock market has been unpredictable, with many investors fearing that we're heading for a downturn. Bonds, which are typically seen as safer investments, aren't looking too promising either, largely because interest rates have been fluctuating. With fewer safe places to put their money, investors are turning to gold, which they perceive as a more reliable store of value. Now you might be asking, why gold? Why not something else like real estate or stocks? This is where the concept of gold as a safe haven comes in. Historically, gold has always been seen as a dependable store of wealth, especially in times of crisis. Unlike stocks, which are tied to the performance of individual companies, or bonds, which depend on interest rates, gold is different. It doesn't generate any income, but it doesn't lose value overnight because a company had a bad quarter or because a government changed its policies. It's scarce, durable, and recognized globally as valuable. That's why, in moments of financial instability, gold tends to shine the brightest. People have been turning to gold during tough economic times for centuries, whether it's during the Great Depression, the 1970s stagflation, or the 2008 financial crisis. Gold has always been the fallback for investors looking to safeguard their wealth. In fact, this pattern goes back even further in history. Kings and queens would hoard gold during wars, and even today, central banks stockpile it to back up their currencies. There's something almost primal about gold's appeal in uncertain times. It's tangible, unlike digital currency or stocks, and it's been a measure of wealth for thousands of years. Another reason for gold's appeal is that it acts as a guard against inflation. When inflation rises, the value of money goes down, but gold has historically retained its purchasing power. Let's say someone bought $100,000 worth of gold at the start of the COVID-19 pandemic. By now, their investment would be worth almost $180,000, while the value of that same amount of cash would have dropped significantly due to inflation. That's a key reason people turn to gold in times like these. They're looking for something that will hold its value no matter what happens to the economy. But is this sudden rush into gold a sign of bigger problems for the US economy? In many ways, yes. When investors pour into gold, it usually means they don't have much confidence in other areas of the economy. For example, rising gold prices often go hand in hand with unstable markets, high inflation, or fears of a recession. This isn't necessarily a good sign. It indicates that investors are worried about the future and are taking steps to protect themselves from what they see as looming economic challenges. The Federal Reserve, which is responsible for managing US monetary policy, is keeping a close eye on this gold rush as well. The Fed has been trying to walk a tightrope between fighting inflation and keeping the economy growing. One of the ways they do this, when they raise rates to combat inflation, it makes borrowing more expensive, which can slow down economic growth. but if they lower rates too much, it can weaken the dollar, which often pushes more people toward gold as a safer investment. It's a delicate balance, and the 2024 gold rush is a clear signal that many investors think the Fed's policies might not be enough to stabilize the economy. This gold rush doesn't just affect the financial markets, it trickles down to regular people too. When gold prices rise, it often sends a message to the public that there's trouble on the horizon. Rising inflation, for instance, makes everyday goods more expensive, and when wages don't keep up, consumers start to feel the pinch. High gold prices can sometimes signal to people that they should be more cautious with their spending, which can reduce overall consumer confidence. And since consumer spending drives a big part of the US economy, any slowdown in that area could lead to broader economic issues like slower growth and higher unemployment. Historically, we've seen gold rushes like this before, and they usually follow similar patterns. Take the 1970s, for example. Back then, the US was grappling with high inflation, stagnant growth, and energy crises. Gold prices skyrocketed as investors scrambled to protect their wealth. A similar situation occurred during the 2008 financial crisis. As banks collapsed and markets tumbled, gold prices surged as people looked for a safe place to park their money. Even during the COVID-19 pandemic, when the future of the global economy seemed uncertain, gold prices hit record highs. The outcomes of these gold rushes offer some valuable lessons. While gold can provide a short-term sense of security during a crisis, it's important to remember that it's not a perfect solution. Over-relying on gold can be risky, especially if the economy stabilizes or if inflation starts to ease. In those cases, gold prices can fall just as quickly as they rose. Moreover, since gold doesn't generate income like stocks or bonds, holding too much gold in a portfolio can mean missing out on potential growth from other investments. As gold prices soar, it raises another question. What happens to traditional investments like stocks and bonds? In times of crisis, there's often an inverse relationship between gold and the stock market. When people flock to gold, it's usually because they're pulling their money out of stocks. That's what we're seeing in 2024. As gold becomes more attractive, the stock market becomes more volatile, with some investors fearing that we could be headed for a downturn. Bonds, which are usually considered safer than stocks, aren't looking so great either, especially with interest rates bouncing around. This means that many investors are shifting their focus to gold, at least for the time being. The 2024 gold rush isn't just about investors trying to safeguard their policies, it's also about who's driving the demand. Institutional investors like hedge funds, central banks, and large investment firms are major players in the surge. Central banks in particular have been increasing their gold reserves as a way to protect their currencies, especially in countries like China, Russia, and India. These nations are diversifying away from the US dollar due to geopolitical tensions and trade wars, turning to gold as a hedge against potential economic disruptions. But it's not just the big players. Retail investors, as in everyday people, are also getting in on the action. With more access to gold through digital platforms and apps, individuals are buying gold coins, bullion, and even gold-backed ETFs or exchange-traded funds. This increase in retail demand shows that the public is becoming more aware of the risks in the economy and is looking for ways to protect their savings. All this activity raises another important point. Is there such a thing as too much gold? Relying too heavily on gold can be risky. While gold is great for preserving value in the short term, it doesn't produce any income. That means if gold prices fall, there's no way to make up for those losses. Plus, gold's value is heavily influenced by investor sentiment. If people suddenly decide that the economy isn't as bad as they thought, they could sell off their gold, causing prices to plummet. The 2024 gold rush is a reflection of broader economic fears, rising inflation, market volatility, and geopolitical instability. While gold provides a sense of security during these uncertain times, it's important to remember that no investment is without risks. As investors, central banks, and governments navigate this complex landscape, the decisions they make will shape the future of the US economy. For now, gold remains a safe harbor in a stormy financial sea, but whether it will continue to rise or fall depends on the unpredictable tides of the global economy. As the 2024 gold rush unfolds, it's crucial to stay informed and cautious. This trend could reveal deeper economic issues that might affect us all in the long run. If you enjoyed this video, make sure to like, subscribe, and hit the notification bell so you don't miss any of our latest updates. Do let us know your thoughts in the comments section, and we'll see you guys next time.